Welcome to all on my YouTube channel. First of all, thank you for all the people for watching my all videos. Also, guys, don't forget to subscribe and notify my channel. Please comment and like also on my particular videos so I can make the better videos in the future. I can also learn from this comment also. So this is my fourth videos regarding to the basic to pro series of the share market. So I will explain first agenda, and after that I will explain one by one. So let's start with the agenda first. So first is what is meant by intraday and delivery, means long term trading. After that, what is bullish, bearish, buy and sell, short and long position. These are the basic concept, basic things to know before the trading. After that, what is the risk management? This is a We need to follow the risk management. So I will explain they are like four aspects like entry, stop loss, trailing stop loss, exit in the risk management. After that, what is the price and volume? After that, how and where to open DEMAT account, because this is a very needful, like how to manage manage the accounts and where we need to open the DEMAT accounts basically. This is the agenda of this today's videos, so I will explain the one by one. So let's move ahead to the next. So first, what is meant by intraday and delivery means long term. So first let's start with intraday. Intraday, also called as MIS. MIS means margin intraday square off. So let's start with the definition. So the term intraday means within the day. As the name itself suggests, intraday trading refers to the purchasing and selling of stock within the same day, right? So intraday means we need to buy and sell the stock within the day. This is called as a intraday, and this is also called as a margin intraday square off. So also known as day trading, intraday trading aims to capitalize on a short-term price movement and leveraging market volatility to generate profits. So the purpose of intraday means we are we buy some stock at the morning, and we need to sell this stock at the before the closing market. We need to sell this stock, right? This is called as intraday, means within the trade, within the day trading means. So also I forgot to exit this position at the before the closing. So this position will be automatically square through the broker. So this is a square of like margin intraday square of. In the intraday, there is a we are like there is a, some like a leverage through the broker. Like we are there is a there is a receive margin benefits of intraday like as a concept, like a leverage concept. Let's consider one example. Like I buy these stocks like 10 quantity with 500 rupees Tata Power stock. Let's assume that Tata Power stock means uh, for this stock we need to buy we need to amount like should be like 5,000, right? As per the like quantity and as price. But I have amount like for 300, like 3,000 rupees. But in intraday we are receive the some margin benefits from the uh, broker through as a concept like a leverage concept. So this whole trading amount will be 5,000 required, but through the 3,000 we taking the some leverage amount to the broker, and we are adding we are taking we are trading this stock in the intraday. But so when we enter the stock in the morning, or after 11 p.m. or at any time, we need to sell this stock or we need to exit this position before the closing market, right? Or this position will be automatically square up before the closing market. So this is called as intraday. And delivery trading, delivery and long-term trading. Delivery trading means long-term, and long-term means cash and carry. CNC means cash and carry. So first with the definition, cash and carry is used for delivery-based trading in equity, right? In delivery-based trading, individuals have the freedom to hold stock overnight for any desired duration. This is the more important in the long-term trading. There is a freedom to hold the stock like 1 day, 2 days, 1 year, or 2 year. There is no restrictions to sell the stock within the day or within the some duration. But in the intraday, there is some restriction. There is a restrictions to buy, sell the stock within the day, right? When using the CNC product type, there is no provision of leverage. But in the delivery or long-term trading, there is no provision of leverage, right? We need to pay the full trading amount in the long-term trading. And in the long delivery trading also, in the delivery long-term trading, the position will not be automatically square up through the broker, right? But in the intraday, this position will be automatically square up before the closing the market in that same day. But in the delivery or in the long-term trading, there is no automatically square up. We can hold this, or we have the freedom to hold the stock overnight for any desired duration. Means let's assume that like I buy this 10 stock with 500 rupees. In that trading amount with 5,000 rupees, but in the long-term trading we need to pay full trading amount. But in the intraday we can benefits of this some leverage. We can we have the like a 2,000 rupees amount, but from this 2,000 amount we can buy this stock, buy this we can trade this stock. But in the long-term trading there is a no provision of the leverage, right? So we also in the long-term trading we can hold this stock like after 1 day, 2 day, or 1 year. There is no any restriction. We have the freedom. After that, I will explain the differences in between the intraday and delivery trading with feature wise. So first with the meaning. When you buy and sell a stock within the same day, as I said in the definition, we need to buy and sell the stock within the same day, right? And in the delivery trading means CNC trading, when you purchase shares and hold them overnight, then you take the delivery of the shares. Means you hold this stock like overnight. There is no any restriction to sell the stock at this time or in this duration. There is a freedom in the delivery trading. Brokerage regarding, there is a low brokerage charged in the for the intraday, and most brokers charges is higher brokerage for the delivery trading. Regarding to the brokerage, transfer of ownership, uh, there is a no for the intraday trading, because we need to buy and sell these within the day, so there is no any ownership. But in the delivery trading there is a yes, we have the ownership, because we hold the stock and we buy the stock as an owner. So in the ownership for the long-term trading, yes, risk factor is a high. And in the delivery trading there is a low risk factor, right? Because in the within the day there is a market will be like more volatile and there is a risk factor is high. But in the delivery trading the we can hold this stock, like there is no any restrictions to sell the stock in the duration, so there is a freedom. So and market will be like a volatile, there is no issue for this volatile market, we can hold this, right? So this risk factor will be low. After that, regarding to the charges, you receive margin benefits on intraday trading. As I said in the definition, you receive the margin benefits as regarding to the like leverage on intraday trading. But in the delivery trading, you have to pay the full value of shares, and the shares get credited to your account. Because in the delivery trading, we are the owner, we have the ownership, so we need to pay the full amount of this trading. So we have to pay the full value of the shares get credited to your account. So this is regarding to the charges, we need to pay the full amount of the trading. This is overall regarding to the intraday and long-term trading. So I I will explain the more about in the next slides. So let's move on to the next slide. What is bullish, uh, bearish, buy and sell, long and short position? So let's start with the one by one. What is what is bullish? Bullish means optimistic and bullish sentiments. Bullish means optimistic or sentiments. It refers to a belief that investment will increase in the value in the future, right? Means we buy some stocks and with our sentiments regarding to the market will be going, our market or our investment will be increased in the future. Means we buy these stocks like 10 quantity with 100 rupees, like BHL Bhopal example, let's consider. And this price will be going up in the future. This is our sentiments are optimistic. So this is called as a bullish sentiments or bullish, right? As I said in the is in the image also, like mentioned that like refers to the optimistic beliefs that the prices will go up. The name derives from a bull striking their horn upwards. Bullish means the bull striking their horns upwards, means market will be going up, right? Here also, this is called a bullish. And bearish on the other hand, on the opposite of the bullish, right? Bearish on the other hand means pessimistic, right? Means a sentiments hour. This is the sentiments of this pessimistic. Means the generally refers to the beliefs that investment price will fall in the future. Means our sentiments or pessimists, like when the prices, our investment prices will be fall in the future. So this is called as a bearish. Also mentioned in the image, bearish sentiments means this bull, this bear. This is a bear, and used to describe the belief that prices will go down, deriving from the downward paw motion of a bear strike with. Means this is a bear motion with the paw with a downward side. So market will be going down in the future, right? These words are taking through the like this a bull and bear. Bull means this horn, a bull striking their horn upwards means optimistic. We are hoping like market will be going up and we can getting the like some amount of the profits, right? And the bearish sentiments, like these pessimists were taking from this like a bear, like a downward promotion of the bear strike with. Promotion is a downward. So we are hoping the market or our investment will be going down in the fall in the future. So this is a bearish, right? So let's moving on to the next, like what is buy, right? Buying in the trading is the act of purchasing an asset in the hope that it will increases, thus the potential making the profit. Like it is important. Buying in a trading is the act of purchasing an asset in the hope that its value will increase. Means we are hoping the market will be going up in the future, so we can buy an asset, right? And that's buying position, and this purchasing the asset, this is called as buy, like thus potentially making the trader profit, right? Means let's consider this example, like I hoping this market will be going up, we are buying this, we are purchasing this stock at this position, and this position will be buy, right? Like potentially making a trader profit with market will going up. And sale is exactly opposite, right? In a trading, selling is the act of offloading an asset once it has returned the trader a sufficient profit, right? Or if it has made a loss, the trader is willing to take, right? Means we can assume that this uh, our favor, like market will be going up, means act as offloading an asset. These are the buying position, but after and then sometime or after some days the market will be going here, and we want to like sufficient profit, we are making the sufficient profit, so we need to offloading an asset once it had returned the trader sufficient profit. So offloading means we need to sell this asset here. This is called in favor of the market going up, but in the market will be going up down, means we are willing to take some losses, and we need to exit this position, we need to sell this position, and this position also called as a sell position. This is called a sale, right? In the buy and sell, there is a concept of the bid and ask price, right? Bid and ask price are the prices at which buyers and sellers are willing to trade a particular asset. Means the prices are the prices at which buyers and sellers are willing to trade a particular asset. Means let's assume that to an example. Uh, let's consider the Tata Power stock. A right example, 10 quantity with 400, right? This 400 price for the Tata Power means, as a buyer purpose, the bid price is represent the highest price a buyer is willing to pay for an asset, right? This is the this 400 rupees price is the highest price of this highest price a buyer is willing to pay for this an asset. Means after some time these market prices will be going up 410, but our highest price a buyer is willing to pay for an asset is a 400. We need to buy this price, buy that price, we need to buy this price, and we are willing to pay as a buyer to this is our highest price, right? As a bid. And the ask price represent the lowest price at which a seller is willing to sell an asset, right? As a buyer, this stocks and the opposition side, there is also seller also available to sell this stock, right? And this buying and selling are willing to trade this particular asset. This is called as a spread, right? Means This current stock price is going sometime is a 405, but a buyer is willing to pay at highest price is willing to for this asset is a 400. This is the highest price of this bid, and seller means ask price represents the lowest price at which a seller is willing to sell an asset. Means seller is willing to sell this asset at lowest price is a 400, right? Means bidding bid means buyer and seller means ask, right? Means this bid and ask trading with buyer and seller with our particular limits, and we are willing to purchase how much is the highest price and how much is the lowest price to sell, and this is called a spread, right? And this both are the agree with this both of these agrees with this asset particular asset, like a bid like to buy this highest price and sell with the lowest price to willing to sell this asset, right? Means price at which the buyer is willing to pay and the price at which the seller is willing to sell. Yeah, so this is an example through the like bid. What is a bid and ask? I explained like bid means highest price a buyer is willing to pay for an asset, and lowest price at which a seller is willing to sell an asset. This is the ask price. In that example, the 400 price is agrees with both like bid and ask, and this through the trade is called a spread, right? Means for this bid, this is the highest price to buy, and the seller means ask is the lowest price to sell, and this through the trading, right? This is called a bid and ask price. Long position. A long position refers to the purchase of an asset with the expectation it will increase in the value in the bullish attitude. Means we expected that the market will be going up, right? A long position refers to the purchase of an asset with the expectation it will increase the value in the bullish attitude. Means we expected the market will be going up. That's why we expected at this point, and we are buying this stock at this position, and after some time this stock we need to sell, so we making this profit, and this ways is called as a long position, right? As I say, also in the mention in the image, when you buy when you open a position with the buy command, you are long, you make the money when prices rise, right? And then exact opposite of the short position. Short position or shorting refers to a selling or security first and buying it back later. Exact opposite, with anticipation that the prices will drop and profit can be made. Our trader purpose is like making the profit, right? In the long position, first we need to buy and then we need to sell. Our purpose is to, in the both position, purpose is making the profit, right? But in the trade is a trend is a different. In the long position, trend is a bullish, and we need to buy and sell these positions. First buy and then sell. But in the short position, trend is a downward. We anticipated that the market will be going down. That's why we need to first sell this security first and then uh, buying it back later with the anticipations. So we are making the some profits. First we need to sell and then need to buy, right? Also in the image mentioned that like when you open a position with the sell command, like you are short, first means you need to first sell and you need to buy. You make the money when the prices will fall. Our anticipation is correct, then we are making the profit in the both trend, right? Through the long position and short position. So this is all overall the like bullish, bearish, buy and sell, what is the bid and ask price, long position and short position. Let's move on to the next slide. What is the risk management? This is the most important in the trading. What is the risk management, right? Let's start with the first entry. An entry point refers to the price at which an investor initiates a position in a security. An entry point refers to the price at which an investor initiates a position in a security. A trade entry can be initiated with either a buy order for a long position and a sell order for the short position. Entry point means, what is entry point? Entry point, as I said in the last slide, this is the long position, right? We are assuming this for the long position, and these are for the short position, right? So in the long position, we are expected the market will be going up, right? So then we need to first buy, and that position is called as entry point, right? And in the short position, we are anticipated that the market will be going down, and first we need to sell, right, in that position. So that position is called as the entry point, right? Understood? Like in the entry point in the buy for the bullish trend, so market will be going up and market will be going down in the bullish bearish trend. So first we need to sell, so that point is called as a entry point. Let's start with stop loss. Stop loss can be defined as an advance order to sell an asset. Stop loss can be defined as an advance order to sell an asset when it reaches a particular price point. It is used to limit loss or gain in a trade. So this purpose and the concept can be used for the short term as well as the long term trading, right? So this is the most important stop loss. Like I will explain through the example. Let's consider the one example like a Tata Motors. Current price is a 400, right? And we are buying this 10 stock with 100 rupees. So this whole amount will be 1000. We are considering then the long position through the in that example. We are expected the market will be going up, right? But uh, but after some time the market will be going down. And this 100 rupee will be going down 90 rupees, 80 rupees, 70 rupees. Without stop loss order, we can't like uh, minimize our losses. We without stop loss order, we are like making the more loss in our this trading. And this is a stop loss context. Stop loss concept is in that order we are expecting the market will be going up, right? And current price is 100 rupees, but after some time the market will be going down and we are already ordered a stop loss order. In that stop loss order we are at 90 rupees, we are ordering the stop loss SL order, right? We are set this order at 90 rupees SL order. Means the we are expecting the market will be going up, but after some time the market will be going down and down, but we are already set order at 90 rupees, right? Means this is an automatic order that an investor places with the broker agent by paying certain amount of a brokerage, right? Means we already paying a certain amount of a brokerage or a broker. Means when we market will be going down opposite of our expectation, and it reaches up to the 90 rupees, the broker will be execute this order at 90 rupees automatically. Means this this stop loss order will minimize the our maximum losses through the stop loss order, because I don't know, we don't know the market will be going like 90, 80, 70, 60, 50 up to say we are like up to say, 50 rupees. We are not reducing, we are not minimizing the, we are minimizing the losses through the stop loss, because we are execute this order at 90 rupees and we are reducing the 10 rupees loss for the only 100 rupees, right? This is the maximizing the minimize the maximum losses through the stop loss order. This is the stop loss. Stop loss is also known as the stop order, stop market order. By placing a stop loss order, the investor instruct the broker agent to sell a security when it reaches the set price limit. This is example for the long position, and in the short position, exact opposite. In the short position, we are anticipating the market will be going fall, right? We buy the we sell this stock first. We need to, in the short position, we need to first sell, right? So 10 into 100, right? 10 quantity and 10 price for the Tata Motors, right? And we are expecting the market will be going down, but market will be going up, our opposite, through the opposite side, our expectation 105 and 120 and 150. At this situation, we set this stop loss at 105 rupees and we are reducing the losses, right? These are the stop loss. Let's moving ahead to the trailing stop loss. Trailing stop loss is an advanced version of a stop loss. Trailing stop loss basically is an advanced version of a stop loss. Trailing stop loss is an automated trading order aimed at protecting gain and limiting losses. This trailing stop loss is not only limiting the losses, also protecting the gains. I will explain through the example. A sets a stop order at a specific percentage or dollar amount of away from a security marketplace. We need to add the trailing gap in that trailing stop loss. I will example let's 10 quantity of this Tata Power stock at a 400 price, right? So we need to pay in the 4,000 rupees. We are adding the stop loss order at a 390 rupees SL order, SL. An advanced version of this trailing stop loss at 1 rupees. We are so a specific percentage or dollar amount away from this securities marketplace. We need to maintain the trailing gap at 1 rupees. Like as the security price increases, the stop order trail along moving up, means we are expecting the market will be going up, right? And this 400 price will be going up to 410 rupees. Like when we buy this stock, we are targeting the our price, right? Some target. I will explain the target, but in that example, I will explain that our target price is 400. Let's consider 430. So after some time, market will be going to the 410. So this stop loss order will be automatically moving. As I said in the definition, as the security price increases, the stop order trail along moving up with the trailing stop loss. This gap will be moving up, right? Like this 410 at current now. So how much you increase? The 10 rupees. So this one trailing gap means 10 rupees increase, then 10 by 1 means this stop loss order also moving up with 10 rupees, means new stop loss order is at 400, right? And this is also 1. means, and after some time this order will be going to the 415, this price, and this stop loss order also moving up 5 rupees. 400 is 5. Maintain the gap through the trailing stop loss, right? And after that, after our target order is a 430, but after some time or the news there is an impact, like market will be going down, right? At the conversely, if the price will decreases, the stop order remains stationary. At the uptrend, the gap will be maintained through the trailing stop loss, but in the downtrend, the stop loss order remains stationary. These are not moving to the downtrend side, right? Means this 415 price will be downward to the 405. Means this ensures that the trade remains open as long the price is moving in the trader's favors automatically closing if the market changes the direction by the set percentage amount. Means our target is a 430, uh, but our target is not hitting. Market will be goes up to the 450, 420, but after some time market will be going down, 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 right? So at the stage 415, the market will be going down up to the 405, and our new stop loss order is a 405 because we can maintain through this trailing stop loss gap, right? 1 rupees, right? Like we bought the stock at 400 and now is a 415, but sometime this first reaches to the 415, means 15 gap. This 15 gap will be increased through the trailing stop loss, means to 392 stop loss order now is a 405, and after that sometime this market will be going down and this market will reaches down, down, down. At this stage, when this stop loss order remains stationary, when this market will be going down, and this market will be going down, down, and reaches to the 405. That time this stop loss order will be exit automatically at 405, right? Means trailing stop loss is a loss locks in the profits while mitigating potential loss and providing important investment tools of the investors. The main purpose, like, we are not making the full profit at the as I predetermined like 4,300 target, but we are making the sum amount of the profit because we are buying this stock at the 400 rupees, but we are selling the stock at a 405. We are not making the more profit, but we are making the some amount of the profit through the trailing stop loss, because we can maintain this gap through the trailing stop loss. And at this stage, like, we can making the 5 rupees and quantity is 10, so this amount will be 50. So current we are selling price will be like we are making the 50 rupees profit through this trade. We are not making the more profit, but we are making the some amount of profit through the trailing stop loss. This is the trailing stop loss. Next is the exit target, an exit point in a price at which an investor closes their position. As I said in the example, when we enter in the stocks, we are set this some target amount. This target amount is a 430. So when investor close their position, usually the investor sell the asset at the exit point. Means our expectation, our anticipation is correct and we are hitting the target, means 403, so we need to exit this position, right? This is for the long trend position, right? Means example, in the long position we enter in the entry in the here, right? And exit, we reaches our target price, so we need to exit at that point. So this is called as an exit, right? like investors sell an asset and exit point to close their position, but in the short position we need to first sell, right? So at exit position is a buy, right? Means in the long position the exit position is a sell. At exit position we need to sell, but in the short position we need to buy at the exit position. This is called a long short position. For example, if Anil buys a share at 400 rupees, after a month market price of a share becomes 450 rupees, and Anil decide to sell this share at this price, this 450 rupees become the exit position of this trade. So this 450 rupees we need to sell the stock, and this is our target or exit position. This is overall regarding to the entry, stop loss, trailing stop loss, and exit and target. Let's moving ahead to the what is the risk management through the all, right? What is risk management sheet with example? I will explain like one by one. What is the risk, how to manage the risk, and overall with feature wise, right? I assume that this one example here in that sheet. So I assume that the total capital, my total capital is 18,000. Our trading capital, our not trading capital, our total capital, right? First stage is a capital management. How to manage the risk? Like first stage is the capital management. In the capital management, our capital total capital is 80,000. And what should be the our trading capital? Trading capital is the 20% of the total capital. This is important. 25% of this our total capital. Total capital. This should be 25%. Means our total capital is in that example 80,000, right? It's 80,000, 25% is to 20,000. This is our trading capital, right? And what should be the our risk per trade? Means what will be the like our we can bear the like losses for the per trade. This is the risk per trade, and this should be 1 or 2% of the trading capital in the F&O market, future and options. This should be 1 or 2% only, and 2 and 5% of this trading capital in equity trading, right? So I mentioned is 1,000 in the 2 to 5% of trading capital for the equity related. So I will explain the equity related example in that sheet. This is the 5%. I consider the maximum percentage of this trading capital risk per trade. This is a 1,000 like a 20,000 5% is 1,000. So this is our one risk per trade. This is totally capital management, right? After that, next quality management. I already explained in the last slide like what is entry, what is stop loss, what is trailing stop loss, right? So let's consider the one example. This is a Tata Power. I will explain the Tata Power stock example today. So when can I take this entry point? Through the like pick up the stock entry point as per the chart analysis, right? I will explain the today example is the long position. Means we are anticipating the market will be going up, right? So this entry point will be analysis through this chart analysis. So this is our entry point 400. We can set this stop loss like 400, and this is also stop loss set through the our chart analysis. This entry and stop loss set through the chart analysis. I will explain the what is do this chart analysis in the next future videos. What is entry and what is stop loss? What should be entry and what should be the stop loss, right? After that, what is the rupees loss per share, right? So rupees loss definition is a entry minus stop loss. entry minus stop loss. Let's consider example for this long term position. So rupees loss will be entry minus stop loss. So in that example, entry is for 420 and stop loss is 400. So rupees loss is a 20 rupees per loss. Also, we need to add the trailing stop loss, some value to rise. We need to maintain this trailing gap, right? Trailing stop loss, I already explained the last videos. Automated trading order aimed at protecting gain and limiting loss. Means we need to protect this gain and limiting losses. As I said in the last example, 1 rupees maintained to gap to like a trailing stop loss. I'll explain like when we market will be going up and up, this gap will be maintained also stop loss through this trailing stop loss. But in the market will be in some case market will be going down after some time, the stop loss will be stationary. I'll explain in the last example. So we need to add this trailing stop loss in that example also, right? And what are the calculated quantity for this particular trade? So quantity is equal to risk per trade divided by the rupees loss. Already calculated the risk per trade. This is 1000 is the risk per trade, and rupees loss also calculated through the this entry minus stop loss. So we are calculated this 50 quantity for the Tata Power share. Means we already all the management calculated before the trading. How much amount will be, how much quantity will be we need to buy. What is the entry, what is the top loss, what is trailing stop loss, what should be our trading capital, what should be our risk per trade, already set in the predetermined before the trading, right? And after that, uh, what should be our target, right? So this is our as per our trading ways. The market will be more bullish, then our target should be the like 1:1. So we can hit the target like 1000 rupees, right? Our market will be going on bullish trend in a strong way. So the target will be like 1:2. So our market, our we can making the profit 2000 in a one trade, right? And as like 1:2 through 3000. So this is a very strong bullish trend. So these are the target hit and stop loss hit. When we in that example, when we reaches the target hit as to 1:1, we are making the 1000 profit for 1:1, 1:2 for the 2000, 1:3 for the 3000. And when we stop loss hit, the stop loss will be our 1000 only, right? Means we are making the profit is 1:3, and we stop loss hitting only the 1000 rupees. We are hitting the risk per trade is only 1000. Let's consider this is our one trade regarding, but in the our trading capital will be 20,000 in the 1000 cap in the one trade. We already in case the stop loss hit will be lost in the 1000 rupees only. So right, but let's consider the what will be the like maximum losses and what will be the trade we need to how much trade with to maximum losses. Let's consider the our trades will be back-to-back trade losses. So when we back-to-back losing the trades, 10 trades, that time only 10,000 amount will be losing from our trading capital, right? And when we like 50 trade maximum losses, like 50 trade back-to-back, that time only 50,000 amount will be losing from our trading capital. And back-to-back 20 trade losses, that time only will be losing our whole trading capital amount. But this is not possible. Back-to-back 10 trading losses and back-to-back 15 losses, back-to-back 20 trading losing trades. This is not possible, but we can manage the risk. Like our trading capital reach like losing through the we need to trade like a 20 trades back to back with losing, but this is not possible, right? There is a probability like when we like a or coin will be like a one time head, one time tail, one time head, one time tail, but again head will be going like up, means we can back to back five the trade five doing the five trades. In that trade we are losing the three times and we can making the two times, means three times lose means 3000 loots in that example, right? And in that example we can hitting the target like 1:2 means 4000, means there is a like we can manage the risk, and we can manage our risk trading capital also, and we can manage our total capital also through this sheet. This is the risk management sheet, and this is very helpful in your trading life and your trading capital, how much to the manage our trading capital and how total capital through our trading purpose. These I said already for the maximum losses, but these are not possible like back to back 20 trading losses. This is not possible, but I assume that like in case in our bad luck and we can losing the back to back 20 trading losses, that time only we are losing this whole trading capital, not total capital, only trading capital, right? But this is not possible in the real, but our management is a backend test, like predetermined test, right? This is called as a risk management. Let's moving to the next. What is the price and value? So price and value, basically, what is the price? Price is the value of stock index or price of a single stock. Means in that our trading purpose, Tata Motors current price is 400 rupees. So this is called as a price. Current price is 400 rupees. The price is the value of the stock index or the price of a single stock, right? Value. Volume is typically the trading volume. Volume is typically the trading volume of a stock index or a single stock during a given period of time, including the trading volume per minute, per daily, monthly, yearly. The volume of stock index is the total amount of money traded during the amount of time, while that the single stock can refer to either the total number of shares transacted or the total amount of money traded. This volume will be created for the in the definition mentioned that like given a period of time, including the per minute, daily, monthly, yearly, because this current price is a 4,400, and let's consider the one buyer is buy the stock at a 10 quantity, means this value will be 4,000, right? At some time or after some time, this 15 stock will be buy at a 400 rupees. This will be like 60,000 total. So this 4,000, 6,000, this is a trading volume. This will be changed. This will be considered for the per minute, per hour, per like 15 minutes, as I said in the definition. Like a trading volume of a stock in a single stock. This consider only consider also single stock during a given period of time, including the trading volume per minute, daily, monthly, yearly. So this is our total trading volume, right? uh, the value of a stock is the total amount of money traded during a amount of time, means at a particular time how much will be traded for this particular stock and how much amount will be traded at a particular time. So while that the single stock and can refer either the total number of shares transacted and total amount of money traded, this is called as volume, right? Volume means how much quantity will be traded at a time. In this time will be changed like minute wise. And there is a big relationship like price and volume relationship, and this impact will be better, or this will be conclusion to analysis, or we need to buy or we need to sell through the price and volume relationship. Price and volume relationship is the term used to the stock market. Price volume relationship refers to the relationship between the price and volume. This is the relationship between the price and volume, which is rather important indicator in the stock market. This is the rather important indicator in the stock market. Price is the value of stock index of the price of a single stock. It mainly refers to the closing price, but may also refers to the opening high low price. Price is the price. At the current price, opening price, low price, these are the price regarding. The volume of a stock index generally refers to the total amount of money traded. Means let's consider this time 10 a.m. right? At this 10 a.m. how much trader will execute this stock? Means let's consider that 400 rupees. The let's consider this uh, only consider 10 stock will be traded, right? Means that's this amount will be 4,000 rupees. So this trading volume will be means the volume of stock index generally refers to the total amount of money traded. Means this amount will be traded 4,000 at 10 a.m. So this is already value. The volume of a single stock can refer to either the total number of shares transacted or the total number of traded. Means this is a particular only 10 a.m. This L 10 a.m. this volume will be changed because the more traders will be executing this trade at the 10:10 a.m. So this is basically how much traders will be enter in that trade with time, and they calculate the volume that wise time wise. In the security markets, there is a relationship between the rise and fall of a stock index or stock, the trading volume during the same period. Such a relationship called as prime volume relation. In the security markets, there is a relationship between the rise and fall of a stock index or stocks and its trading volume during the same period. Such as a relationship is called as a price volume relationship. A crucial indicator for investors to anticipate the future trends. Means through the price and value relationship, we can anticipate the future markets will be going up or going down through the price volume relationship. And I calculated the sum, or I analyzed the some relationship in that images, price and volume relationship, right? So I will explain the one by one. This first is a when the price is going up and volume also going up, that time strong uptrend supported by the volume. This is important. And looking for the buying opportunity means this both trend will be going up, that time the buying opportunity will be strong, so we can buy that, we can buy the some stock at this going this both trends will be going up. This is the buying opportunity. Second is the price will be going up related to the some stock, but the volume will be going down, right? Means uptrend not supported by value. In that case, up volume is supported to the uptrend, means strong uptrend, but in that case the volume is not supported to the price, right? Means uptrend up not supported to the uptrend. Means we already uh, we already buy this stock at this position, and this position means price will be up but volume will be low, so we can exit the long position. That point we can exit this position, and through which analysis? Through this analysis, means price will be high or going up but volume will be low, so that time we can exit your long position. This after that price will be down and volume will be increased. Means at this position, at this position through the market will be going down. Means the price will be low and volume will be increased. Means this trend will be going downward. So that point we can analyze through this price volume relationship. Means price will be uh, price at this point is a low and down, but volume will be up. Means downtrend supported by the volume. Means this downtrend supported by the value means looking for the selling opportunity. Means we can this here short position. We can do the short position at this point through the price value relationship. And next is a uh, price will be down and the volume also down. Means downtrend not supported by volume means the downtrend not supported by value means exit your short entry. Means this market will be going down, 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 down. At this position means downtrend now supported by value means price will be so low and volume also low. Then downtrend now supported by the volume. That time we already enter this short position. We already sell this and we need to exit your short entry at this point. And we can analyze through this price value relationship. Means downtrend not supported by value means exit your short entry. This is regarding to the price and value relationship, and this analysis will be very helpful in your future tradings. So let's move into the next slide, and this is a important like how and where do we open the DEMAT account. First, I will explain the how. As per my experience and as per my understanding, please create the separate account to each trading purpose. The trading purpose should be like this trading purpose will be like intraday, long term, future and trading. So there are many ways through trading ways. So please create the separate account to each trading purpose, such as create and one account for long term trading purpose. For intraday purpose, use the account for from another broker, like a future and box, future and options. Also create the another account through the another broker. Main purpose of this creation of these many accounts is this will be easier for handling the different transaction and more transparency about trading output, right? And also trading growth. This is called how to create these accounts and where to create the how to manage the accounts basically, and where I mentioned suggesting to use these brokers for trading purpose as per below. These are the example related. Not I am suggesting to create this account in that broker. I am I am putting the one example and where do on means as per my experience these brokers are good for the my. So but we can suggest to another another guider to where we need to where we need to open this account. But by my understanding, I am suggesting to like for the long term position, long term gain, we need to create like we are suggesting to the create the in the Jiroda create the account. For the intraday swing and positional trading, create the account in the through the angel broker, and future and options through the upstock, and for the mutual fund related to the gain grow. For the my suggestion or my understanding from my understanding or experience, I suggesting to uh, these are the good brokers, but you can suggest you can take the suggestion for the another persons which you want to good brokers, but create the separate account for the each trading purpose. This is the main and purpose. Why? because the easier for handling the different transactions and more transparency about the trading output. So this is regarding to the how and where to to open the account. And less important and more important, thank you for all the people. Please watch these videos. Also, don't forget to subscribe and notify channel, and also do the comment on that videos and like, because without your commenting I can't understand like where I wrong and where I good. So from this comment I can better videos in the future. So that's why again thank for all the people. Thank you guys. And let's thank you. Take care. Bye bye.